And that was probably a great key into the mindset of successful developers. It's not about winning and losing, it's about winning and learning and, getting on with things and working with your team and communicating to achieve the shared outcome for what you know is possible.
You are listening to the Property Developer Podcast, your home for tips, ideas, and inspiration to help take your developing to the next level. Now, here's your host, Justin Getty.
Hello, and welcome to episode 116 of the show. Great to have you with me. I trust you're well. I'm doing fine. It's been a little bit of a gap between episodes, but here we are. Got a great show for you today. A conversation with someone who's walked both sides of the development world, the delivery grind of medium and high density projects, and the fast moving world of construction finance. If you're trying to get a project off the ground right now, this episode is going to speak directly to the challenges you're facing. We'll get to that in a moment. On the project front, I'm finally close to wrapping up my last development. We've sold the final 2 townhouses and both settle in the next week, which means we can finally draw a line under what has been a very long and extremely challenging project. We're still in discussions with the builder over delay damages, but having all the stock sold is a major relief and a big psychological milestone. Over on the new project, things are finally happening on site. We've started early works, removing soil and preparing for the civil works package, which should kick off in the coming months. It's great to see machinery on the ground and feel the momentum after so much planning and documentation. Now, a lot of people listen to this show because they want to take on a development, but don't really know where to start. If that's you, well, my property developer training program will give you the clarity and structure you need. It's everything I wish I'd known before my first project. How to assess a site properly, build a feasibility that actually reflects reality, lining up your team, and avoiding the traps that cost beginners time and money. If you want to get moving with confidence, then check it out at www.propertydevelopertraining.com. And if you're wondering whether you're actually ready to take on a project, take the quick quiz at www.propertydevelopertraining.com/quiz and find out where you stand. Okay, on to today's guest, Zac Constantinou, who began his career as a junior project manager delivering medium and high density residential developments across Sydney before stepping into the finance world, where he now focuses on construction loans and private capital. Zac brings a rare perspective because he has lived the entire development cycle, end to end, from site acquisition and planning, right through dealing with consultants, builders, financiers, and handover. And now, from the finance side, he sees the full spectrum of what's getting funded and why. In this conversation, we cover why buying well still underpins every successful project, how private capital has stepped into the gap left by major banks, the shift in lender risk appetite and what that means for developers, the importance of strong feasibilities, documented track records, and telling the right lender story, the red flags to look for in both builders and lenders, and how planning reforms, especially in parts of Sydney, are reshaping where development stacks up. We also talk about the broader balancing act developers are wrestling with: build costs, sales prices, wages, inflation, and the supply pressures of a growing population. It's a great conversation. I'm sure you're going to enjoy it. So let's start out by finding out what food Zac would eat until he was sick.
I reckon I'm going to do just that over the Christmas holidays with some tacos.
That's my daughter's go-to. She's a taco fiend.
How good.
Yeah, she's learned how to make them herself, so she'll get busy in the kitchen and start making tacos.
And how about yours?
Yeah, my favorite food?
Correct.
Easy, pizza.
Nice one. Pretty much anything goes on that.
Yes, no, I think it's the saltiness and the crunchiness that works for me.
Love it.
Pizza's been a pretty popular answer over the years. So anyway, let's get rolling into our chat today. Thanks for being on the show. We're going to talk all things development and finance. But let's just get a quick recap of yourself. How did you get into property?
I actually started out of uni as a junior project manager for a developer. So had a bit of exposure to the construction side, the finance side. I was with a pretty well-known developer, arguably one of Sydney's best developers currently. And yeah, they were purely developing. So not an integrated builder, didn't come from a funds management background. They were just, biting and chewing development site after development site, delivering and sustaining what they could.
What kind of projects are we talking about?
Medium to high density residential stuff. I started with, I think it was about 41 units, and it was between 17 and 21 townhouses, and then all the way up to say 500 units and 40 stories of commercial tower in CBD locations. So really diverse, and got exposed to the whole spectrum of consultants, authorities, partners, and financiers in the process.
So, what, junior burger project manager and then worked your way up a little bit?
Yep. Went up the ranks over, I think, about 7 or 8 years or 7 years. And yeah, got a few projects under my belt, which I was leading. And then, yeah, got a bit of an itch to shake things up and add some more strings to my bow.
And what were the kind of things that you picked up in those roles?
Oh, look, I mean, where do you start? The development life cycle, to paint it with a broad brush from acquisitions to handover. I mean, the developer had a pure acquisitions team. And in the project management side of things, there was always liaison when they were looking at sites to make sure the numbers stack, make sure the planning worked, get indicative advice and schemes done so that, an offer could be meaningful to lock up the site. And I think that was one of the biggest learnings was from the director of acquisitions there. You buy well and then everything else just costs you money. So it's really, really important in the acquisitions phases. Probably one of the key parts of the process, as you know. But yeah, then from there, the whole planning suite, from SSDA approvals to just run-of-the-mill council DAs, and then delivering it. So contracting a builder, engaging a pre-sale strategy, and working with the in-house sales and marketing team, and moving it all the way through that 2, 3, sometimes 5 year complete life cycle from acquisitions to delivery, to then see occupants or investors of hundreds and hundreds of units acquire mortgages to settle the things, and then obviously that's where the developer takes their cream.
And is there a particular project that stands out for you for either good reasons or reasons that were a bit trickier or tougher?
Oh, look, I think smooth sailing never made a good sailor, and that's why the ones with the trials and tribulations seem to stand out, because you end up spending a lot more time and effort on them, and obviously learning a lot of things. And that was probably a great key into the mindset of successful developers. Like, it's not about winning and losing. It's about winning and learning, and getting on with things and working with your team and communicating to achieve the shared outcome for what is possible. Probably one was 21 townhouses. We went through a few builders down in South Sydney there, and look, we ended up delivering the project. But yeah, I think it was just one of those sites from the beginning that had a few hairs on it. That bit of a rescue mission from a developer who couldn't complete on it, and yeah, we ended up with a bit of a hospital pass and just had to grit our teeth and get it done. But yeah, that taught us a lot about working with consultants and getting the right builder at a time where you think it's going to be a cost-cutting exercise. That's when you want to make sure you're getting what you pay for, and you know what you're paying for.
And so, how did you make the move from projects to the finance side?
Yeah, great question. Oh, look, it was a bit of a eyes closed, head first, off the deep end maneuver. But look, as I said, project life cycles are 3 to 5 years, start to finish, and felt like the right time to make a bit of a change of pace and yeah, not completely distance myself from, 7 rewarding but hard years as a PM. So it was, I guess, with a little bit of a little bit of apprehension that I'd handed my resignation, but yeah, I landed at Shaw Financial, actually, with a role and a lot of learnings to come as a residential mortgage broker because that's the core business. But there are a few guys in the office that are from a commercial background in banks and of the like. So it was a good sort of entry to, I guess, honing that finance aspect to what I'd already come from.
But what drew you into the financial side? Because I mean, it's one component, a very important component, an essential component of any project, but only one component. It's probably, I mean, from my opinion, it's not the kind of sexiest part of a project. Certainly one of the most critical, but what drew you towards finance?
Yeah, look, a couple of things that I think, you probably know better than most, being, right at the coalface. The numbers don't lie, and it's about controlling the numbers and making sure that, you're in love with the deal and, not just the actual property. So understanding the numbers and having the numbers stack up is, paramount. It's critical to any offer and, making sure that you can actually afford what your known costs are before you enter into a deal, and obviously the pace of things as well. I'm lucky to be young enough to not have too many commitments that allowed me to make a fairly flexible move to pivot into a new career. So yeah, the change of pace was pretty enticing, and that's probably the two reasons that made me want to jump ship.
Is there a one or two things that have sort of surprised you by moving into the new role, and what have you also learned about yourself with the change?
I think, what have I learned about myself? Yeah, I think, look, it's like communication and just being available as, the professional that's relied upon for details and connections and relationships you know, to suit a certain deal. Like you've got to be available. And that was, I guess one thing about the structure here at Shore is that, we've got the flexibility to be self-employed, and, that means that we're also a lot more flexible with our time. I've only got one mobile number, and I'm proud to be answering calls at whatever hour and, for whatever reason, if it's to do with work, because I do love what I do. And yeah, I mean, probably the other thing is just like the mechanics of the finance space in terms of how deals are structured, and the breadth of lenders and players out there for pretty much every different type of deal. Like you learn pretty quickly that there's a minimum requirement and deals need certain things to stack up, but you can also find lenders with some pretty large degrees of flexibility that will be willing to work with you on a JV space or stretching their senior debt. So yeah, relationships and that side of it was something that I was very very excited to learn and have seen the best parts of it.
Well, the last couple of years have been really challenging with rising costs and things getting stretched. What have you observed yourself from the finance side of the fence? I'm sure there was lots of saving that needed to be, or people who needed help and getting out of trouble in terms of loans expiring or loans no longer covering costs. What have you observed and seen over the last few years?
Yeah, I think COVID was one of those canary in the coal mine events, and nobody ever saw that coming, number one. And there was quite a large hangover from a project delivery standpoint, a cost escalation standpoint, and everybody just getting used to the new norm. Construction costs went up Mount Everest, and like that got passed on directly to the capital side of the feasibility, and who's paying the bills and what the project stacks up to be, and therefore that gets passed on into sales prices. So that was a big thing that maybe changed, or that definitely changed the risk appetite for a lot of the lenders and obviously the developers. Then some of them who are able to sustain and maybe, pull back a little bit and just weather the storm did so. And, there were also unfortunately quite a few that are not operating due to the times that they felt that they've fallen on, purely because of the market conditions. Like, there's been huge scrutiny on valuations, build costs, track records of the sponsors and stuff like that. Like, it's certainly, it, in my opinion, it's been a great time to be on this side of the fence because, you really understand the full spectrum of, the considerations that go into funding these things.
And so what's been those lessons around the the sponsors and the financial risk assessment from lenders?
Yeah, I think, look, there's both sides of the fence have come to the party on certain things. Developers are needing to prove more experience and be more transparent and, show their track record of delivery. They've also got to show a very, very clean exit. There's been, some interpretation that construction costs are stabilizing, but that's, I guess, still to be seen, to be passed on. In terms of the lending side, there's increasing appetite for stretching that senior debt level to work with, the increased capital costs. Because at the end of the day, if the project doesn't get off the ground, well, that means the lender's not getting money out the door. So it's a bit of a two-way street for everyone to work together and bite and chew and swallow and do everything that they need to do to keep the lights on and keep the deals flowing.
And so I know a lot of private capital or second tier type capital has moved into the development space. Is that something that you've also noticed? Or the majors sort of still a bit tentative?
Yeah, I think a lot of the headlines were there's been an explosion of private credit. And look, that's again down to a few things like the risk appetite of, some of the major banks and the previous major players, and just the general understanding of property and development amongst, the traditional lenders. Whereas, in the private capital market, there's speed and flexibility and a greater degree of risk tolerance with, some of the players in the space that are non-bank institutions, non-institutional capital, mortgage funds, family offices, high net worth individuals. They've seen the opening in that, the typical players have pulled back, the majors have pulled back. They don't have the appetite for that exposure. So some of the other entities have been entering the market, and that's what we've seen.
And so how do you go about accessing this type of funding? Like, how does it differ from regular bank funding? Is it structured differently?
Yeah, so I mean, access to it is, through a valued intermediary. Like brokers do a lot of the heavy lifting in the finance space. There's obviously more and more brokers entering the commercial space to, pick up the slack of, the appetite for lenders, and obviously just helping developers and builders and stuff like that get their head around the numbers, the structure feasibilities, and what their options are. Because yeah, there's, like, I would say there's probably 150 to 200 that, I have a spreadsheet of in terms of lenders in the space for any sort of project. In terms of how they differ from some of the traditional players, there's that stretched senior position, so LVRs above the traditional 65%. There's second mortgages available, so it's really getting to that debt level that A, the project can handle, and B, that's suitable to the client in terms of what their goals are to actually deliver it. Obviously, the rates are a bit higher, 9 to 15%. There's, still a few guys that are down that lower end. The terms are between 6 to 24 months, and they offer, capitalized interest and some flexible sort of terms on line fees and stuff like that. But I suppose where it outperforms, or where private capital outperforms, the traditional bank funding, is speed, flexibility, and risk tolerance. there's just more people that understand the projects at a greater degree. They're not matrix oriented; they're more relationship oriented. They might be an area specialist um, or deal specific in terms of if it's an industrial deal or a childcare development or a multi-res or a high density res. They might have that specific experience from deals in their wheelhouse. But I look, and on the other side, like where it falls short, yeah, there's the cost. It's obviously a bit higher. The scale, for the larger deals, there's still probably some pretty cheap money out there from some of the banks or the larger institutions rather than the private capital. Um, and then look, consistency. Like there's each lender has their own set of terms, mandate, or policies from wherever they warehouse or syndicate from. So consistency isn't really a thing in the space, whereas the majors or some of the matrix lenders, like what you're up for, whereas there's quite a bit more change in the terms available in the private space.
And then how do you satisfy yourself with those people that you have on your books? Because I know there's been plenty of people sort of entering the lending sector, as it were, and some of them perhaps don't have a strong track record, or you're really not so sure about their bona fides. How do you go about satisfying yourself that they're legit and strong?
Yeah, I'll look at that's a great point. Would definitely be steering people away from people who have preceding reputations, horror stories, denied extensions, and you know, take control of things. So, um, I guess everyone's probably heard of one of those stories. I haven't particularly been involved in one of those myself, but you know who they are, and you tend to advise on that basis that the due diligence behind the lender that you're proposing is someone of stature, someone you know that holds relationship at a paramount, that understands the deal and also wants the solution, based on the exit, but also has that position, whether it's based on the feasibility or based on capacity to stretch, that if they do need to extend, well, there's numbers, there's a line in the sand that shows what's possible.
Are you seeing facilities stick within their timeframes now, or are they still stretching out? I mean, I know there was a period there where every project was going, a year over. What about now?
I think everyone's made a concerted effort to bring things in on time. It's just, the on budget factor that's still probably up in the air. But yeah, extensions, as I said, like they're common. You want to avoid them because you get charged other establishment fees and stuff like that from the lender because they have to, essentially refinance themselves or, get refinanced with another private funder. So, look, it is possible. Whether or not it's available in the feasibility will dictate what the next step is. But people are definitely more conscious of, hitting that time frame so that they're not, fully drawn and at the cap of the feasibility or the LVR, that they've got no more options. So having that clear exit and making sure that the client understands exactly what that exit means and what they must deliver on is something that we drive home.
And I would imagine that the selection of the builder is more important than it ever has been from a lending point of view.
Yeah, without a doubt. And even the ones that are willing to, open their books so that you can see their balance sheet, that they're not struggling for float or, robbing Peter to pay Paul or waiting on other jobs to complete before they can continue on the one that you're engaged on. Yeah, it's certainly speaks much louder than the ones that won't be willing to open their books. But look, then again, there's existing relationships where there's trust that may not need to be the case, and therefore there's track record, in terms of the jobs that they've got on, the jobs that they've got coming up, and where they've come from. Because now is a great time to see who's been able to weather the storm and kick on accordingly, rather than the ones that are on the way out.
So you have seen projects from the inside and the outside. What would you say is something that developers often underestimate during project delivery?
Yeah, I think Look, it's making sure that I think I said it before in terms of, having all the numbers ready to go and understanding, the breadth of scenarios for what happens if the sales figures come in, 10% down on what your original feasibility said, or if they creep up or costs go which way. It's having the modeling and the feasibilities done um, to you'd almost call it the nth degree, but no one has time or capacity to do that many revisions. But you've got to show that you've got some mitigating parameters there that shows that it works, give or take either side, that it still works with the exit. In terms of underestimating, probably yeah, the capital costs. Um, I've seen recently the developers that are doing well, and it might just be, the next generation, the mid-30s guys that have had, some career or some experience in the development space, or they've, been building on their own for the last 5, 6, 7 years. Now they're starting to pair up, and it really gives them a nice layer of integration. And it's almost like the bare minimum now in terms of maybe like the survivorship of the development industry, like finding a developer now that is just purely a developer. Um, I'm, yeah, like there's, you've either got to have a big equity check to balance out your costs in the door and an approval ready to go so that you can fund the whole lot on the upside, or you're a builder developer and you've got, control over that margin on the build and that flexibility to play both sides.
Well, it is helpful when you've got a builder and some margin that you can layer in there, isn't it?
Absolutely.
And then there's been a lot of changes to planning, particularly in New South Wales, also in Victoria. I think some of the other states kind of tinkering around a bit, but definitely in Victoria and New South Wales, there's been changes to the planning systems to try and push things through faster, get approvals quicker. Are you seeing anything material happen on that front around Sydney or New South Wales or other markets that you might be exposed to?
Oh, look, Sydney in particular has had quite a few changes under the LMR reforms and the transport-oriented developments in the last year. So, yes, we are seeing some materialistic impacts. And take Castle Hill, for example, in the northwest of Sydney, or towards the northwest. It's got a great new metro station, and now the rezoning under the LMR has captured a lot of that town centre to deliver uplift under a few different chapters of the SEPP. And that's brought some key players in terms of sites into focus. They've had some preliminary planning, and now their eyes are lighting up because they've sat on these sites for the last 15 years. They bought well. They're not necessarily developers. And in fact, they're completely removed from the industry and in different industries themselves, but they've clued on. They understand what the opportunity is, and above 1,800 square meters within, I think, 600 meters or 400 meters of um, the CBD of Castle Hill means that now you've got potentially a couple of mixed use sites and a residential house, and they might be worth $2.5 million each individually, but in one line, it hits the trigger for that aggregate minimum square meterage, and they can go up to potentially 30, 40 stories. And I think we're going to see a few other things take place in the new year or the next 12 months to support a couple of different editions of what's possible within those areas. So definitely people moving. And I guess in the last couple of years, there was always talk of the transport-oriented development sites, and some of the developers that maybe pulled back during COVID and kept some of their powder dry, actually deployed that to purchase sites that obviously still a risk, but were flagged to be captured under some of the imminent controls at the time. So yeah, certainly a bit more movement on the horizon. I feel like it's going to be a busy next couple of years.
And then what do you think is going to happen just in terms of the rising build costs versus and the rising end sales prices versus the not so fast rising wages and interest rates?
I think, look, any movement in interest rate generally directly impacts sentiment. Downwards would be great. But I think wage growth was one of the key things that's, now factoring into inflation at the moment as well. So, yeah, we should get the crystal ball out for the next one of these to see what it says. But yeah, in terms of the road forward, construction cost wise, I think from what I've seen and what everybody else seems to be saying, they're not going to go down. It's just, are they going to stop going up so aggressively? Which I think we've already seen that happen. Um, and cost of capital in terms of where the lending side of the funds are coming from. If rates are moving down and money gets cheaper, we'll, I guess, expect more things to get out of the ground sooner because money's easier to come by, right?
What about if they start inching up?
We shall see.
It seems it's a sort of delicate balance at the moment between the escalating build costs, the required end sales prices to make the projects work, wages to be able to pay those higher end sales prices, and lending capacity based on the rates, and then the availability of credit based on the rates and how cheap money is. So it's sort of this delicate balancing act at the moment from my perspective.
Yeah, exactly. I mean, it's also, where the stock is actually, becoming available, like where the supply is driving, and you're exactly right. Like the affordability of it is one thing because at the end of the day, they might have a pre-sales requirement for 50% of debt cover, but that might only be 35% of the sales of the building. So then you've got residual stock facilities that need to then come into play from the private capital to fund the next development for that developer because they're holding on to stock. So it is a delicate balance, and yeah, there's a lot of factors, on like once it's delivered, who's buying them and can they afford them? Are they being delivered affordably, in the right areas? And I think one of the things that I learned at the development company I was at. Was that their philosophy was investing where there's investments in infrastructure. So looking at the right infrastructure. So, there's obviously been the big metro developments that I think a lot of those have been delivered by Daycorp up the Northwest Line. Third Eye's delivering one in Crow's Nest. There's quite a few key developers that are on to that side of things. And you look at the demographics, like it's connected to amenity. The metro's 6 minutes into the city. That's where seemingly the affordability needs to remain so that people can, be close to work, schools, hospitals, stuff like that. And the other infrastructure piece of where are the hospitals and the schools and universities going, that's, where the philosophy from, I guess, where I've learnt about development seems to have succeeded from.
Yes, I think there used to be the Bunnings or the McDonald's principals looking to see where they're putting in their new stores are usually where the growth is happening.
Absolutely.
Zach, what would you say the best piece of advice is that you've received along your property career?
I probably have to go back to, you make all the money up front when you buy. Like you really have to know what you're buying and what the upside is, because like after you buy what you think's possible, the build's going to cost you, the holding costs are going to cost you, the lending costs are going to cost you. So you really need to know pretty much what you're going to sell and for how much, you know, 3 years ahead of when you're walking in with an offer. So that you can be assured that your feasibility stacks up. That's from the development side, probably the best piece of advice and what I've seen, acted on for almost over a decade now by the developer that I was working for.
Yeah, it's such a tricky thing to do in a volatile environment, and particularly, I mean, we're past COVID now, but there's certainly still some wash happening in terms of some of the impacts on what happened in property and across the broader economy. So it's still a bit volatile, whereas I think prior to 2020, it was a little bit easier to forecast what was going to happen with property.
I think also the rinse and repeat strategy, right? Like working to a strict set of deal parameters rather than chopping and changing. Once you find something that works, just keep looking for the next one.
Yeah, well, for a lot of people that sort of stopped working after COVID and the costs that came along, so people have had to pivot and try different things, as you touched on, whether that's partnering or looking at a different project type.
Yeah, exactly. I mean, look, there's no denying that, networking and relationship building, like, can get you out of whatever situation that you're faced with, because, if you can't figure it out yourself, go find someone that can help you do it.
Yeah, and I think we found that out during the last couple of years. Who were the good people on your team that did help you get through some of those sticky scenarios?
Oh, absolutely.
Yeah, I certainly found out which people on my team were super useful, which, as you say, when you're in trouble and you got those reliable people, it makes all the difference.
It does.
Now, Zach, for developers who are looking to take their developing to the next level, what would you say they should focus on?
Oh, look, networking, surrounding yourself with a team of people, valuers, consultants, builders, brokers like myself, agents, so that you're not isolated, and you've got the team ready to go when you think you found a deal. Probably ensuring that you've got the lender story, the pitch, something like something that illustrates the track record, the experience, the capability of you, your entity, whoever else is involved, if you're integrated, if you're not, so that there's really no questions on, is this person experienced? Because you don't want to shift the focus away from what the deal is based on if they don't know who you are. So, documenting everything, making sure that you've got clear feasibilities. Like I do get calls from people, asking me to run numbers on sites and, does this work? Will this work? It's like, I'm not the developer, and you should know your numbers. You should understand, that there are planning tools out there that can, educate you on what a floor space ratio is, what's permissible on the site in terms of the metrics and, the square meterage, gross floor area, stuff like that. Getting some indicative planning advice, like it could be like the best $5,000 you spend on a site that you think works after you've done some of your research. I mean, it might save you a whole lot more before going down the rabbit hole, or it might open the door to a highly profitable development. So having that, and yeah, having the funding stack, rationalized. So once you've got your idea of what's available from a permissibility standpoint, run the numbers and then figure out how you're gonna fund it. So whether you're bringing your own equity or whether you can use residual stock, or if you're just starting out, do you have a partner to help you balance out, what's left in the LVR that the lender won't cover. So yeah, network, funding, documentation of things, including your experience and what the opportunity is. I think that's a minimum benchmark for anyone looking to get out of the ground.
Now, tell me, is there something that you miss about the project delivery, the project management?
I mean, no. It's it'll be something that I come back to for sure. But for the moment, I yeah definitely enjoy the finance side, the pace of it, and seeing just the breadth of deals that happen in the state and around the country. So yeah, look, I'll leave the professionals to deal with the builders on site, and we can just ensure that we're all on the same page from a numbers perspective.
Yeah, that the money flows and flows in and then flows back out again.
Yeah, exactly.
Now, Zach, if people are interested in connecting with you or finding out more about you, where can they go or what can they do?
Yeah, I'll look. will we leave a link in the notes of this recording or something? Otherwise, I'm happy to send you my tag on Instagram. I'm a senior credit advisor at Shaw Financial. Obviously, you've heard a little bit about my experience in development. I only got one mobile number or an email, and that's attached to my LinkedIn or my Instagram. So you can connect with me there, see a little bit more about myself on both of those parts,
Oh, yes, and
both
it's
those platforms.
SHORE.
Correct.
Sure Financial. All right, Zac, any last comments before we wrap it up and let you go?
Oh man, I didn't really prepare for a last comment, to be honest. I've really enjoyed speaking with you, Justin, and yeah, I think look, things are looking up. It's, as you said, a delicate balance um, of capital costs, funding, site selection, and experience. So, the right people always find their way to the top, and the good deals, seem to be the ones that are taking the cake at the moment. So, yeah, I guess have a rewind of this, and you'll hear about what the good deals sound like, so that you can make sure you're approaching it correctly.
Well, we are Australia. We do have opportunities coming, or the opportunities around the country. Different states are in different times of the cycle. We also have a growing population with people moving here, so they need somewhere to live. So over the short to medium term, there's a need for property development. So there's opportunities around the place. You just got to hunt them down.
Absolutely. Keep running the numbers, keep looking at the sites. There'll be one for everyone.
Yeah, got to keep searching for it. All right, Zac, it's been really great speaking with you today. Always nice to talk to someone who understands both sides of the fence, the actual developing side and the financial side. So it's always great to get their perspective. So thanks for being on the Property Developer Podcast.
Thanks for having me, Justin. Appreciate your time.
See you later.
You've been listening to the Property Developer Podcast. Tune in next time for more tips, ideas and inspiration to take your developing to the next level. For more developing love, make sure to visit propertydeveloperpodcast.com.